Hello again at fairbinaryoptions.com. We are looking at the stochastic indicator or oscillator, one of the most important indicators of them all, in order to try to filter good signals from bad signals when trading the currency markets and when trading binary options based on the currency markets. On the first part of this mini educational series that you can find on the Binary Options Academy. On the first part, we showed you how to apply the stochastic indicator on a chart, and on the second part now I'm going to show you exactly how to filter good signals from bad signals, because as you can see, the oscillator travels all over the place. I'm talking about values here and here, price moving on nothing at all, and the oscillator trying to let's say mimic the price. Now again, as a short review, what is above the 80 represents overbought territory, what is below the 20 represents oversold. In overbought, we normally we should go and buy put options. In the oversold, we should go and buy call options. Only like that, without filtering anything. If you go from left to right, this is the Great Britain pound US dollar 1 hour chart. If you go from left to right, and let's say from here, so this would be a signal when the green dotted line goes above the blue line into the overbought territory. This is a signal to go and actually buy put options. Now as you can see, the market goes all the way to the downside. So from that moment of time, let's try to put here, so this would be a place to go and buy put options. This will be the signal based on the oscillator, and from that moment of time the market moves to the downside up to this moment of time when we have a signal to buy call options, because the market is of course oversold. Now from here to here we had a distance of 10 candles. So taking into consideration the fact that the market is on the 1 hour chart here, you may choose your expiration date based on that. In order to pick the right expiration date based on the time frame, regardless of the time frame that you are looking for, such a distance is normal. So somewhere between 8 and 10 candles on a signal generated by stochastic is good enough. So you wait for 8 or 10 candles. Now normally this should translate in a 5-minute chart. If you go in 10 candles, that you have almost 1 hour 50 minutes. So trading the 1 hour expiration date based on that is going to be enough. If you are looking at the 1 hour chart, then you may even trade end of day expiration date if you are buying the option in the second part of the trading day, or even in the first half of the trading day. Now in the lower part here we have a bullish signal, so whenever you have a bullish signal we should look to buy call options here. And from this moment of time, again, if you drag 10 candles, something like this, 6, 7, 8, 9, 10 candles, and you still have, so from here, where is the signal? From here, and you still have an option that expire in the money, just like that, 10 candles, 7 to 8 candles, the option expires in the money. And then you have another signal here to the downside this time, right on this candle, and you may go and buy put option this time. And if you go and take a look at the 10 candles somewhere around here, would still be sorry, will still be in the money and in profit. Then another signal here to filter to the upside and so on. Now this is one way to judge on how to buy call options or put options based on the stochastic, but we need to filter it somehow. As you can see, the trend is clearly to the downside, so the path of least resistance or the option that are going to expire here in the money more often are going to be the put options. Well, here is where you come with the very definition of a trend. What is a trend? Now a trend needs to have a minimum, or to start with a minimum series of two higher highs, two lower highs, sorry, or two higher lows. Now in this case, in order for this to be considered, so this is a nice place to go and buy This is a nice place to go and buy call options because you had a previous low. So another higher low, and you buy call options. So the signal is all right. This is a nice signal to go and buy put options because you have a previous higher high. But this one is not a place to buy call options anymore because the previous low here was not lower than this low. So the prerequisites of a trend are not satisfied, and then you wait for the signal to come for the call option. You don't have a signal here. You don't have for put options. You don't have a signal here because the stochastic is not in the overbought territory. You wait here. This is not a bearish. This is not a bullish trend where you should buy because you don't have a series of higher lows. And then this is the moment in here and in here. This is a moment where you should filter, and from this moment on only to look to buy put options when the stochastic turns down. So this is a moment where you should buy put options. This is another moment where we should buy put options. As the trend is clearly to the downside, we don't have a series of two lower highs, of two higher lows, but only lower highs. And every time the oscillator goes above or into the oversold territory here, meaning here, and here, meaning here, we should only go and buy put options as the market keeps falling to the downside, and including here, and including here. It is quite straightforward. It is quite, let's say, risky to go and buy call options in a trend that is falling, and therefore if you want to sit on the right side of things, the stochastic may just help you pick the right places to go into the market. Thank you for being here. Make sure you check the Binary Options Academy, as we have a lot of examples on how to trade binary options based on different indicators. Thank you, and bye bye.